Hello, everyone. This is Ernie Humphrey, the CEO of Treasury Webinars. Thank you so much for taking the time to join us for our webinar today, M&A from a Treasury perspective, integration risk, opportunities, pitfalls. Very excited on the topic today. I don't think I've gotten to talk about M&A from a Treasury perspective for many years, so I'm excited. I'm always excited to have my co-speaker, John Paquette, with me. He's the VP of Solutions in the U.S. for a key strategic partner of mine, TIS. John, before we jump in, why don't you go ahead and give us a little bit about your background, and welcome, as always.
Yeah, thanks, Ernie. Sure, happy to do that. So I'm John Paquette. I oversee our solutions team for the U.S. market. That's our, pre-sales functions plus our client onboarding team as well. Joined TIS back in 2019. Previous to that, though, I was a Treasury practitioner. I spent, 15 years in the space directly working in Treasury for different organizations. Some of those actually had a pretty high M&A level as well. So this is a topic I'm very interested to speak on here today. And thanks as always for having me, Ernie.
Thanks, John. Also want to, of course, thank a TIS long-term thought leadership partner of mine. They share my commitment to serving the Treasury and finance professions, but also impacting the career success of the Treasury and finance professions. Just a few notes as far as the logistics go. If you're interested in receiving a copy of today's webinar deck or interested in receiving a certificate of attendance, please send an email to Ernie@treasurywebinars.com. Again, that's Ernie@treasurywebinars.com. So let's go ahead and first of all, let's do a little lay of the land here and give you a little sense of the journey we're going to go on today. And so first, we're going to start at the top level, and it's really important that you have a Treasury integration roadmap. There's a lot of different ways to set out your roadmap. It's just important that you have that roadmap. And so I'll just offer my perspective on what I've found to work and from the many conversations I've had. And then we'll talk about how to get the lay of the land at the acquired company. It's incredibly important that you start to build relationships as soon as you're allowed to at the acquired company to know what you're getting into, what the culture is, the relationships that you might keep, and relationships you might need to back away from. And so you need to start deciding if you're going to have to back away. How do you do that gracefully? It's extremely important to have very good relationships with someone at the acquired company, someone that you can call, but also someone that feels comfortable calling you. And so back in my day at Franklin Electric, we had this acquisition at this place called Philtite, and I just became the Philtite guy. So I think it was 5 or 6 years after the acquisition, people would call me because I was the Philtite guy, and that's the kind of person that you want to be. You really want to be plugged in. We'll talk about cash visibility and control before and after the merger, how to go about having your Treasury policies and control alignment, importance of automating your processes and aligning systems, and then we'll bring everything together and we'll add a few other categories. I mean, John and I could do probably 10 webinars on this M&A integration topic, so we're going to touch a lot of things at a pretty high level, and I know John would be happy to have a conversation with you after the webinar if you want to dive deep as would I. And then we're going to talk about how to capitalize on opportunities for synergies, and sometimes it seems like that's not possible, but at the end of the day, the cat's meow is to find ways to make your Treasury department offer even more value after the acquisition. So let's go ahead and kick things off with the polling question. It's one thing I forgot to really make clear is M&A is really on the rise. I know we've had records in terms of number of deals, and so it's definitely something that has some traction. So just interested. So John and I can talk a little bit, get a little bit of sense of what you're into or what you might get into. So we're asking you expect to be involved maybe the next 3 months, 6 to 9 months, 12 to 24 months. Maybe that's something you're not seeing, but maybe you're involved in one right now. So hopefully wherever you're at, whether you're going through one, we'll go through one, and maybe one you're not expecting, John and I will give you some insights and we'll tell you about a lot of things that went right, things to avoid. And I've made a lot of mistakes during my acquisition experience, and so hopefully I will keep you from making some of those. A couple of things I'll say over and over and over again: relationships and communication are key. So I'm going to give you guys a few more seconds, and then we'll take a quick peek at the results, and then we'll kind of dive in. And don't worry, I'll let John speak quite a bit today, so you can get a break from hearing me the whole time. So let's go ahead, close the poll. Let's go ahead and take a quick look. Exciting, John. We have 22% of the people that are involved in one right now, and so there's only 28% that don't see it within the next 2 years, and you never know, that could happen. And so just want to comment there. So we definitely have some attentive folks here, John, and so we're going to give them some amazing content and conversations. And as always, we can take your questions in the questions area of your GoToWebinar control panel anytime. If we don't get to your questions, feel free. John and I will connect with you after the webinar. So let's take a look. Really start things out at a high level with the roadmap. And so it's a winding road. And so no matter what you think or what you're told, it's a winding road. And so the first step I have is get the lay of the land and build relationships. Now, what you're really ideally is you're involved in that due diligence checklist. And so you really want to kind of weasel your way in there and make sure you get on the due diligence checklist, because the more you know, the better. I'll share some stories that I've run into, things I didn't know because they weren't on the due diligence checklist. There's one company we acquired, and the guy was trading pension assets on E-Trade. And so some of those things you'll kind of run into. So you want to get the lay of the land, you want to build those relationships. And then 2 is more like, I say, day 1, cash visibility and cash control. I'll share a few stories on that, what cash control meant. And then, of course, a lot of these things can be going on simultaneously, but just to give you a sense of, kind of the timing of things where I think they make sense, you want to align on your Treasury policies and controls, and then you want to start to automate your manual processes and align systems. That's post-acquisition. And then incredibly important is to capitalize on the opportunities for synergy. And so sometimes you'll see that there's gaps, right? Both pre and post merger, and you can actually get more investment in technology and delivering more value. So you can take advantage of those as well. And so we're going to start off and talk about due diligence and relationships. So I'm going to go ahead and I hand the floor over to John. John, take it away, my friend.
All right, thanks, Ernie. Yeah, as Ernie mentioned on the previous slide here, we're going to start with a lot of these lay of the land topics. When we talk about lay of the land, it's really, all those pre-acquisition considerations, all the things that are leading up to that day 1, just being prepared as possible to hit the ground running once the acquisition actually closes here. So we're going to talk about staff considerations, financial systems, relationships, as well as a lot of process and control type considerations, and then ultimately, a lot of the risk exposure type topics as well here. So maybe we'll start here with just talking a little bit about Treasury staffing, at the acquired company. So as we move to the next slide here, so it's really when you acquire companies, a lot of times there's obviously employees that come with those companies, but really that's one of the considerations you have to think about quite a bit. Will there be staff that's being added to your organization? How do they fit into the current team, right? And I guess are there any sort of efficiencies you can pick up as a result of this type of topic? So common times when you're doing an acquisition, you might be moving into a new region or a new market, and so taking on some of that knowledge with the existing company can be really useful, right? So it can help you kind of plug a lot of knowledge gaps you might have in your existing team. But overall, these are good considerations to have. You need to think about ultimately what the training plan is going to be. As you bring these individuals and start to acclimate them into your own team, how do you bring them up to speed on your existing processes? Or maybe the flip side of that too, in terms of how the transfer of knowledge is going to occur. If they have knowledge that your team needs or that you need specifically related to the acquired business, what's that plan, right? How are you going to bring all that knowledge over onto your own team? And then the other piece of this that I think is really important is the communication with the current staff. Obviously when new employees are joining the team, whenever there's an acquisition taking place, everybody wants to know ultimately where they're going to stand as these two kind of worlds collide, right? And where each one of these individuals is going to fit into the overall team. So just having those open lines of communication, having everybody really understand what their role is going to be and any way that it's going to change in the future as a result of this acquisition definitely helps to alleviate, I think, a lot of concerns, going into the ultimate close of that acquisition. So, moving forward here, we talk about maybe as well the financial systems assessments that occur as a result of this before you do an acquisition. When you acquire a company, commonly you also acquire systems as well, right? That's kind of inevitable. And really understanding how those systems are being used by the current employees is obviously a really critical part of the pre-acquisition diligence process. How critical are those systems to their day-to-day processes? What systems are being used? What types of processes are they undertaking on a day-to-day basis, right? Who has access to those systems and things like that too. And also, I think a consideration is if you're just acquiring a portion of the business, will they ultimately lose access to some systems they might rely on because those systems are ultimately owned by the parent company, right? That's a big consideration. And if that occurs, then how do you kind of maintain continuity of processes in those regards? Did a lot of acquisitions back in my day in Treasury that were just asset purchases. And so in those cases, a lot of times we didn't get to actually take on the systems that those individuals are using and those business units were using on a day-to-day basis. And we had to plug those gaps with transition services agreements where the existing teams or parent companies continue to support those processes up to a point in time when we can actually get fully integrated, right? So there could be considerations like that pertaining to the financial systems that are being used. But the most important thing here, like I mentioned before, is just business continuity. When you get to day one there, can everything sort of operate as normal? And ultimately, long term, you can think about how to fully integrate these systems, even phase out or consolidate systems, but just making sure you can operate effectively on day one, I think is really the key consideration, the pre-acquisition consideration as you look at the financial systems assessments. And then also banking relationships, just like systems, you're going to acquire banking relationships as the result of an acquisition. And this is the reason why I think a lot of organizations end up with the convoluted account structures that they do, right? They do a lot of M&A activity and they acquire a lot of bank relationships along the way. And so, just having a general understanding of what the bank relationship landscape looks like for the company that you're acquiring. Also understanding if you're going to take control of those accounts on day one. I think most commonly when there's an acquisition, usually there is some degree of control taken over those accounts, or at least, you're able to plug yourself in to getting visibility into those accounts on day one. And then, fully understanding that structure, the types of accounts, the sweep relationships, the cash management structure is important. But also the services is a good consideration as well, right? Do the accounts have the same degree of services that, allow for the control that you're used to within your organization? Things like fraud prevention type services, debit blocks, all those little things, right? Are they in place the way that they typically would be for a new account that you're opening within your organization? And then, you talk about the bank relationships, treasury services. A big piece of that, like I mentioned, is the cash management structure. Understanding how the cash moves throughout that account structure, what sweep relationships are in place, even any sort of credit facility considerations. Does money move through those accounts a certain way because it's required to as part of a credit relationship is a good thing to consider as well. So a lot of different variables. We could spend a lot of time on just this topic, I think, alone in terms of all the things to understand from a banking standpoint. But those are kind of the key day one type items. And then obviously, as you look more long range, you want to think about, how consolidations might happen within those relationships. Are there relationships you might want to eliminate or fold into some of your main cash management type banking relationships? But that's all sort of post this day one kind of preparedness type activity. And Ernie, maybe I'll hand back to you to talk a little bit about risk exposures and insurance here.
All right, thanks, John. Before we kind of jump forward, I'm going to introduce a few stories along the way. So pre-acquisition, the people, it's really an important aspect, especially if you're buying maybe a little bit of a smaller company. There's going to be someone who really has control, right, over when payments are made, how they're made, and the bank relationships. So you want to identify the people that you want to keep happy, right? There was a couple people I built relationships with. They were less than happy, right, to be going through the acquisition. So to build relationships with them is incredibly important, and also bank relationships. And so sometimes there are some relationships that really were key partners with the company that you're buying, they built. And so really be respectful of those relationships, right? And see if there's a way, if you can use them to really pay them for their loyalty. And so, as soon as I was allowed to, I went and met with all their bank partners, told them what was happening, right? Maybe we'd be stepping away from some of those services, but just to create that goodwill and not to burn any bridges. So just be thinking about that out of the gate. So part of your strategy is, I talk about your network. Okay, how do I build my network of people that work at the company I'm acquiring? But what about their business partners? What about their fintech partners? The better those relationships are, the more smooth that transition is going to go and that integration is going to go. Again, all I can say is communication, communication, communication. And so let's dive in a little bit. topics I haven't really talked about a lot in the Treasury webinars, and so I'm going to try and do a better job of that. Just risk exposures and insurance, and so really you got to get that lay of the land. I mean, this slide is a whole webinar. Risk exposures that need attention on day one. One of the things to look at, let's just say payments risk exposures, right? What are the mitigation tools that you use just regarding to your payments risk exposures? Positive pay, things of that nature. Maybe there's gaps you see in the authorized signers. So anything that's in the due diligence that you see, these are things we need to take care of day one. And there's sometimes you can close those before the acquisition. Of course, you have to be careful in that communication, but I've had instances where I wanted to take care of things that were worrying me day one. And then in terms of what's going on, at the acquired company, how are they currently being managed and mitigated? Do they have any financial instruments? Are they taking advantage? Are there some natural hedging opportunities? What might those look like compared to your exposures, either FX or commodity exposures? And then this one is really critical. And I haven't talked about insurance. I'm working on a webinar on just insurance. And so really understanding what insurance coverages they have, what those gaps are, how you would transition some of those key policies, workers' comp, just everything. You have to. For me, we had a really good insurance broker, and so that can be a key resources. And so, are there any gaps in the coverage for risk exposures you're inheriting? And then, how do you align those insurance coverages with those in place at your company? And so that is a really key part of it. If insurance really falls on you, but I think it's something that is coming more and more into the Treasury arena. So that's incredibly important. That is an entire webinar, but really understanding on day one, right? What are those gaps, and also what exposures in the due diligence piece? And so what are the outstanding claims on workers' comp? Maybe you're self-funded up to a level. Are there states you have to fill out all this paperwork? So understand what you're getting into. Maybe they'll have some beautiful captives, and I'm going to say I'm not a big fan of captives just because we've inherited a few when I was managing, and they're really hard to get out of. So you really need to understand if you need them, how do you get out of them? And so those are incredibly important. Hey, John, do you have any things, any risk exposures that really kind of hit you, kind of blindsided you a little bit, or insurance issues that you want to share that you might be able to give some people some advice for to look at all?
Luckily, I don't think I have any probably examples to bring up related to insurance. I think we had luckily on our side within our team, we had a special sort of team that was responsible for the insurance work stream for acquisitions that sat outside of Treasury. So I think we were fortunate from that standpoint, but I can definitely see this being a big topic like you had alluded to here during this conversation.
Yeah, I had a few just because we were buying a smaller company. One of the companies we had, this guy ran a fireworks business out of a piece of the a building that was in production. So obviously that was interesting. There were boats in people's names. And then as I mentioned before, there are some E-Trade accounts going on. And so, those are just things. And so another thing to point out is that it's really not one size fits all in terms of your due diligence. And so when I was going through acquisitions, I thought, you know what, I think the smaller acquisitions are going to be easier than the big acquisitions. I actually found it to be the opposite. So what I found from my experience, and my experience is mostly in manufacturing acquisitions, were there were many more things to kind of uncover in the small acquisition. So that was interesting from my perspective. So let's go ahead and talk about some relationships before closing. I mentioned these before. And then again, for me, if I was going through it right now, what I would like to ask you to think about is what I would want to copy this presentation so I could just run through this, especially maybe with your staff, right? If you're sending people on site. And so, well, let's step back. Insurance, absolutely. Someone's mentioning, you're absolutely right. People need to be cognizant, right? It's gaps at certainly smaller companies and other companies, just these exposures that you can have as far as cyber, environmental. Oh man, I have some stories about that. So, we dealt in gas fuel. And so, yeah, you can absolutely, when you're looking at the open claims, that's incredibly important. If there's not a cap on the cleanup, hopefully that's negotiated during the closing, these are just things that you need to get as much information as possible. So those relationships, John touched on this as well. Treasury leaders and staff, as you're allowed, right? You don't want to, sometimes it's kind of hush hush with the acquisition, but as soon as you can, build those relationships, show respect to them, right? Appreciation for what they've done, how they're going to fit in, and even if it's not long term, how appreciative you will be if you can help to make the acquisition smooth, recognize on what they've done. Again, talking to those key bank relationships is important, and I like to talk about control of the cash conversion cycle. AP leaders and staff is allowed, and so for me at my company, control of cash meant this is a little bit extreme. On day one acquisition, nothing was getting paid unless it went across my desk, and we were a mid-market company, so I had to see every AP invoice. So we wanted to make sure that they were aligned with our AP policies. No one was approving payments or releasing checks for like 2 months, and so that's a little extreme, but that's what control of cash meant at my company. AR leaders, right? What are the exposures? What's the risk profile? What are your policies right now, right? Do you need to reset your specific, however you put risk buckets? It can be by company, it can be by country, it can be by industry, and so make sure that your AR team is ready for that as well. Again, we talked about risk management. IT leaders is allowed as well, as John mentioned. What are we getting into? What are we able to share? How are we going to share data? How are we going to, this is accounting, how are we going to close the books? Boy, that was exciting. How are we going to consolidate things and close the books? Again, bank relationships and service providers, right? And so I would say, figure out what you're allowed to do, make those, and then your treasury leaders, just ask them, okay, I need to talk to John at Chase. So, how are things with John? And then of course, overarching, a lot of the things we've already talked about, which I should have included, was contracts. And so you may be involved in the contracts. We have to be really, really on top of the contracts, right? If they're treasury services contracts or bank agreements, ISDA agreements, things like that. So, overarching these things that we're inheriting, make sure your due diligence involves contracts. How do we get out of them? Even on the AR and AP side, you might have to change the remittance information, right? So you have to think through, right? If you're centralizing things, right, and not letting them run alone, that's a completely different ball game. So you have to really get down into the weeds, and either yourself or someone on your staff, you really have to talk to folks. So what I did, which I was fortunate to do, I actually went on site to the acquired company, and really I stayed there a week after the acquisition closed to understand, right, make sure, as John said, now day one things kept moving. I understand, the AP and the AR, so they could ask me questions, and we could work on these things together, right? So we weren't getting blindsided. And when the CFO called me in his office, which he did, do you have control of cash? This is my favorite story about control of cash. So there was one company, they had a check stamp, and the only way they got checks out the door was they had a check stamp. So the CFO calls me in. He goes, do you have control of cash? I pulled the check stamp out, and I said, yeah, I do, because they can't make any payments without this check stamp. So don't do that. They don't like that, but that was necessary, from my perspective. So just food for thought on the relationship. So incredibly important. So let's talk about cash control and visibility. John, why don't I go ahead and hand the floor back over to you for a bit, my friend?
Yeah, sounds good. Thanks. Yeah, I think that we work with a lot of acquisition-heavy companies, and all the biggest concerns they usually have is, how do I get that cash visibility into the businesses that I'm acquiring, and how do I institute some level of control over the cash disbursements processes? That's really what they're looking to do immediately in the short term, prior to the real acquisition integration really beginning. So maybe we'll talk a bit about those two topics over the next few slides here. In terms of cash visibility on day one, there's a couple different ways you can go about this. I think you can have a very simple strategy to gaining that visibility, where at the very least, hopefully you get access to the acquired entities e-banking portals, so you can log in, you can run prior day, current day reports, right? You can start to see the flow of money throughout the business. But visibility means, I think, having access to view that information, but having access in a way that really makes it actionable as well, that you can really draw those insights. Because when you do start to have that visibility, you just start to learn so much more about the business that you acquired, right? When you can see their cash movements on a day-to-day basis, things that maybe weren't fully flushed out during the pre-acquisition diligence. So we're also always helping our customers think about strategies for how to collect that information electronically, right? Maybe maybe you receive an electronic bank statement that's forwarded into a provider, a treasury aggregator of some sort, or you piggyback on an existing direct relationship you have, direct connectivity you have with one of your banking partners, and you have, the acquired banking relationships forward their statements into that stream, into that, information stream, so that you can start to receive those directly on a day-to-day basis. And then maybe that helps you, then integrate that information into some sort of reporting or business intelligence tool that you're using today that allows you to really be able to drill into the balance movements, the cash movements, understand their flow of funds at a higher level, right? They're both internally and externally, and both help you, like I mentioned, start to gain some familiarity with the business itself, and then institute a level of control. There's a level of control that comes with having cash visibility, right? So definitely important consideration there. And then cash control on day one, you really have to think about what level of control you're going to have over the actual disbursement of funds from those accounts. I think most commonly you have, most organizations, when they acquire an entity, the first thing they want to do is they want to change the signatories on the acquired bank accounts on day one. So there's a lot of preparedness that goes into that, coordinating with the banking partners, getting the signatures, cards, resolutions, corresponding sort of supporting legal documentation ready to go ahead and hit the ground running and make that change on day one. But then also just understanding generally how the business makes cash disbursements on a day-to-day basis. Are there manual payments? Are there direct system integrations? Are there check runs that go out? How frequently? All these different sort of cash disbursement type processes. And really understanding how to sort of involve yourself into those processes itself, right? Who can approve manual payments currently? Who can release those payments? Who can input those payments? And how do you put yourself into that process at some extent, even if it's just being the final release on manual payments over a certain threshold, or maybe immediately trying to integrate the organization into your existing cash forecasting process so that you have some visibility into what disbursements they plan to make on a week-to-week basis, or just being the final approver of check runs, whatever it might be, right? Just some sort of day-to-day involvement in those disbursements processes. In the future, you can always move towards instituting standard policies and processes that align with how you're dispersing funds on a day-to-day basis, but it's more sort of thinking about how to take control on day one, right? And then I think there's already alluded a lot to the relationships, but the change management around the cash disbursements, I think is really important as well, right? Because you have an acquired entity, they're probably used to operating a certain way on a day-to-day basis, maybe being in charge of their own cash, right? Releasing funds on their own schedules and through their own internal approvals. And now you're bringing another, layer into that as you start to institute some additional controls over that process. So something to definitely consider, and just sort of how do you manage that change management in general, and getting people comfortable with what will ultimately be the new processes and why they are what they are, right? So so ultimately I think that it's something that maybe is easier said than done on some instances, depending on the complexity of the business that you're acquiring. So maybe if it's just one or two banking relationships, one or two systems, it's a fairly simple process to institute some level of manual control over those processes in the short term, and take control of manual payment releases, or approving check runs, or even approving every disbursement that runs through the desk, like Ernie mentioned in that previous example. But if it's more complex than that, it's important to think about if you actually need technology to help you do that, right? Do you need something in the short term to help you unify all these different disparate systems until you get to the point where you can actually truly unify them, truly consolidate systems, ERPs, and things like that too, right? And that's where technology can play, I think, a great role, and how we kind of help a lot of our M&A customers as well, as providing them a platform that they can integrate all these different manual and electronic and system integration type processes into one platform, and ultimately establish a consistent level of control, even though the processes themselves have not yet been centralized. So just another consideration there, I think, is just understanding what resources you ultimately need, right? How do you achieve this both in the short term and long term? And if you actually do need something to supplement your existing strategy to really make that a possibility.
Yeah, thanks, John. So let me go ahead and dovetail a little bit on here. Obviously, all these things are kind of interconnected. So it's not like you just do one, you look at the systems, the controls. And so this can get pretty dicey even with a few different systems. And so, like I said, my CFO wanted control of cash. So they had a different banking platform. So back then, we had a big banking platform that was really out on the front of innovation technologies, easy to use. Well, when we had the acquisition, they were moving money through a pretty big bank, but the cash system was, I would call it a little baby system. So I had to understand that system. So I was running cash from two different systems. I had to understand that system, understand all the controls with that system. And so just being able to centralize control and move that cash can get pretty complicated. So that's why kind of day one, it was important for me to go and sit next to the people that were moving cash and understand the systems and have them help me make things more efficient, things they ran into, and just things like making sure payroll gets done, right? Things that you can't miss. So there are things that you can't miss in terms of, and then acquisition. So the worst thing that can happen, obviously, payroll doesn't get funded. And that almost happened to me, I will confess. And so my bank partner was probably not happy because I was an unhappy individual, to say the least. But those are things you need to really dial in, take control. Like day one, these things need to happen. Who do I need to communicate with? How do I make sure that these things are happening? What types of confirmations do I have? And so just things to think about. So let's talk about, again, could have been talked about earlier, but just to segment it out, policies and control, right? Up front, right? Your due diligence, you should see, do they have Treasury policies at the acquired company? What do they look like? And so as you start to see those or the lack of those, you need to get them ready, right, to be integrated into your culture. So for me, it was a culture of cash control, right? Culture of procedures. They were different. So it was a different mindset. Just things such as, and maybe not Treasury, but I'd say T&E, right? So we don't pay for memberships to the golf club. We don't do these types of things. So we need to figure out how to let people know. And part of it's how things are going to change, right? So as I mentioned, if they exist, how do they align with yours? How do you create alignment? And then how do you communicate the how and why? So obviously they're going to have to kind of fall in line, but how do you communicate that? How do you communicate the value of doing that to them? And then if they don't exist, again, that's a culture change. And so if the people are going to be staying on at the acquired company, it's worth an in-person visit to go down there and kind of explain to that. And really what it comes down to is oftentimes what you're doing is making their lives easier. The other side of that is you should have a mindset of learning. And so it's completely possible that people at the company you acquire do things better than you. And so in the payments world, I know TIS likes to call this payments harmonization, right? And so you take the best practices of everything instead of just looking at it. We do it corporate way, so have that open mind. And that's another way to really identify some opportunities for synergies, right? Because sometimes the people you acquire, they can make things better. So maybe you're managing like insurance and risk, and they're really focused on cash management, so they may have more expertise there. And so it's great when you can add to your team and your skill set. So let's kind of transition on to right sizing technology. Let me go ahead and ask our next polling question here. Be honest, I'm not going to tell on you. Just curious, your thoughts. Do you believe you have the current technology to support Treasury success at your company? Right? Do you believe it's ideal, good, and getting better? It's okay, not good, and poor. What we've seen the last few years on all survey data that I've seen is that investments are being made. And so now is the time to really raise your hand. I know CFOs in general have a bigger appetite to invest in technology. And so I would encourage you to really, if you haven't done so lately, I know that use those of you going through acquisition right now, take a good look in the mirror. Everything that you're doing, every system you use, touch, cold cash conversion cycle, take a look at what's out there, attend webinars, see what's possible. look at that business case, and then go for it. You know, it'll make your life easier. It'll make your company, it'll make you support growth and innovation and make your M&As 1 + 1 = 3 a lot more common. So let's go ahead and close the polling question. Let's take a quick peek here, see where people are at. Ideal is awesome. I'd love for you to speak on a webinar with me because I'd like to know how you got there. See, and so good, we have some opportunity here, right? Okay, not good and poor, so that's well over, not well over, you know, yeah, well over 50%, right? And so my math's bad, on 60% of folks, right, that okay, so you deserve better, all my Treasury people out there, and there's a way to make that business case. And so again, especially after the webinar is over, if you want to you know, schedule some time with John, I know I'd be happy to communicate with you how companies are leveraging technology, right? Cost-effective technology, cloud technology to help you deliver more value from Treasury. So thanks for answering your polling question. John, I'll hand the floor back over to you, and why don't you walk us through, I know it's a whole webinar topic on right-sizing technology.
Yeah, no, I think you're definitely right. There's a lot of considerations here for technology right sizing, but you know, the first one here, I think, is just to make sure that you kind of understand the technology that you're getting into on day one. And is there anything that's actually going to, you know, create a redundancy that actually obscures visibility and standardization within your business? You know, for example, after the acquisition, you're going to actually be managing 2 TMSs now, right, with different feeds for the different banking relationships going into the 2 systems, maybe 2 completely separate manual payments processes and things like that. So it's interesting. I think the next section we're talking about synergies, but you might actually take a step backwards before you can take a step forward here and have to think about how you deal with, you know, some of these redundancies, at least initially here. And they probably play a lot into your staffing considerations too, immediately following the acquisition. And then ultimately, obviously, plans need to be put in place by Treasury teams to think about, you know, how do you make the selection of what's ultimately going to be the system of choice here, and how you're going to consolidate everything down into one system. So definitely a big consideration here. But there can also be short-term wins as a result of these acquisitions. You know, I've done some acquisitions where the business we acquired had great software for, you know, contract management or tracking leases or something like that, right? Some sort of or like an FX risk management type software, some sort of kind of more minor software offering that actually can bring better advantages to the greater business through, you know, broader adoption. So definitely be on the lookout for those too. Is there something that the acquired business is using that can ultimately help your team, and do you want to think about maybe more fully rolling that out? And then the big one is sort of the long range projects, right? So there's always, with every acquisition, at least one or more ERP system that will come with those acquisitions. Ultimately, that's where some of the higher volume payment activity is happening, the AP payments, you know, and ultimately the reconciliation and accounting processes as well. And the consolidations there, they're multi-year projects. They're not going to happen right away, right? So you're going to be dealing with multiple systems for some period of time. And you definitely have to think about what the strategy is going to be to deal with that. How are you going to get your bank feeds into those multiple systems? How are you going to introduce control over those payment processes when you have multiple sources of payment origination, right? So definitely think about the ways that you can unify these. Do you have an existing technology, for instance, that maybe can plug in and give you some sort of consistent level of control over all that activity? Or is it worth kind of looking at something that can help with, you know, short-term acquisition integration type strategies, really sitting in the middle of all these different systems until you can get to the point where you can really start to think about, okay, how are we going to consolidate? How are we going to ultimately reduce our systems in use down to just the right number, the right sizing of ultimately this technology? So I think these are really the key considerations here, but obviously this is a very complex topic, as Ernie alluded to here. I probably could spend, you know, a whole webinar just on this one, right? So, but maybe we'll move on here, and Ernie, I'll hand back to you to talk about some of the, you know, how to capitalize on some of the opportunities for synergies.
Yeah, thanks, John. Just kind of dovetail on that for potential synergies and opportunities to upgrade your technology. So one of the things that obviously a lot of things get more complex, but especially if you're going across borders, right? Maybe the acquired company may have suppliers, customers overseas, and maybe they're not doing the best job, right, at managing all their payments risk exposures and their compliance risk, right, and their bank connectivity. And so those are opportunities that, one, you need it, but also there may be gaps in your existing systems. And so for controls and risk mitigation, for me, I lean a little bit more on technology because that expertise is hard to have in-house. And so those are things where I see you can really help help yourself, everybody, but help yourself as well. And so, opportunities for synergies, right? John and I touched on these. Well, let's keep it simple, right? For people. And so you look at the dynamics of your team as it exists right now. Are there individuals at the acquired company that may fit well into your team? And it may be that you might want to offer these people a job and move them to corporate, right? Consider how they add to your team. And so you want to make sure you're adding value. So look at opportunities there. Process as well. John mentioned really important earlier. We want to make sure that there aren't any processes that are inhibiting efficiencies and really leading to less informed decisions process. And then John did a good job of touching on the technology piece. Not only technology and Treasury, but let's reach out and look at the whole this tech stack under the CFO as well. And so those synergies, right? Well, let's look at those people, how are they additive processes? Maybe there are some better processes, right, at the acquired company. Let's harmonize those policies and technology. As John said, let's do some short-term and long-term and see where the company's going. So to kind of help put a lot of structure around these things and things we really didn't talk about a lot. Again, some of this is really, I think, valuable in terms of reference material. And so for the next few slides, AFP did a really good job. This checklist is posted, I believe it's the Southern Ohio AFP. And so 2017, you might think, oh, that's a little dated. But when I looked at it, I said, no, it's not. I mean, some of the specifics and the specific types of coverages, but this is an incredible tool that an amazing group of Treasury leaders put together. So again, this is just valuable, right? The checklist. So what we're going to do is we're going to kind of, at the top level, and then we'll dive a little bit deeper into some of the areas that we really didn't cover before. Where you stand depends on where you sit. So some of these things might not be relevant, right, to where you are, but you never know in the acquired company or in your career. It's good to know as well. So obviously we talked about bank relationships and accounts. We'll talk about things we want to get doing day one. So what I did was I took a few of these and I took 5 bullet points from a huge checklist under each that I thought were most important. So we'll talk about debt, investments, FX and commodities, letters of credit. Oh man, those were the bane of my existence. Guarantees, benefit plans, which could be a whole other webinar. I actually did a presentation at AFP on acquisition integration for pension plans and 401ks. That can be something that will change your life. Just kidding, but that can be dicey, so that's important. We talked about insurance and then Treasury operations and processes. I think we covered that one quite a bit, so I think we'll leave that for after to talk about after. So John, why don't you go ahead and jump in for us on bank relationships and accounts?
Sure. Yeah, I mean, this is obviously one that the Treasury team will spend an awful lot of time on. It's just collecting the right information about bank relationships and accounts. So you need to understand the account structure, make sure it has sufficient detail that you really need, right? So in terms of the current relationships, anything that might be still in flight, the accounts that are set up, but also the legal entities that own those accounts, the purposes of those accounts, the signatories, all that information, right? It really needs to be the complete source there to sort of effectively transition those activities, and make sure it includes things like legacy bank accounts. I mean, it's pretty common for a business to sort of forget about accounts that are mainly inactive, right, and leave that off the list. And then post acquisition, you find out that there's even more accounts than you realized, right? So, and also the cash management structure, I think, is really important too. Not just the accounts, but how does money move through those accounts? What sweep relationships are in place? Which accounts are the disbursement accounts? Which accounts fund those disbursement accounts? What's a pure operating account, sort of a standalone account? Are there any JV accounts in the mix there? Are there cash pools that the business is using? So just a lot of considerations to really get your arms around the account and cash management structure. And then, you really have to understand who has access and authority over those accounts, even through the e-banking portals, who are ultimately the administrators of those e-banking portals, who are those that have the ability to give people access to accounts or assign entitlements to accounts. Do you want to leave those in place, or do you want to take those over and fold those into your existing processes? And there's also just ancillary type services and processes. So merchant services. I worked for a business that had a pretty heavy credit card processing aspect to it as well. And so understanding the merchant services that are in place, what relationships exist there, how to transition those over is a key consideration for the acquisitions. Or if they're using products like lock boxes or sort of specialized investment or sweep type products as well, for cash management purposes. Really important to understand those too. And I think you have to dig into a little bit, the relationships, but also, if there's an overlap with an existing relationship that you have at a bank currently, how those two relationships can be merged together. I did acquisitions back in my day where it was, the acquired business had the same, major cash management bank as us, and it was like, great, this will be simple. This will be a really easy integration here. But some of these major banks in the U.S. have grown over time through acquisition on their own, and the technology platform sitting in the background can sometimes be pretty, kind of segregated on their own. So, in one instance for me, it was, we acquired a business that had the same relationship as us, but we were on two completely different technology platforms within that bank, and that activity really couldn't be unified. It was almost as if we were managing two separate bank relationships still post-acquisition. And we had to think about a plan how to kind of combine those accounts into the same technology platform post-acquisition. So always be aware of those little minor type considerations as well. You never know what's going to come up. So really dig into those relationships, even the existing ones, to see if there's anything that you have to really consider there.
All right, thanks, John. Let me go ahead and jump back in here. So one of the things, that John mentioned, right, on the bank accounts, and one of the things which is obviously a consideration is your bank fee analysis statements. And so you may have worked at your company to really understand all your bank fees, but what you're going to be getting, they might not be spending as much time on the bank analysis statements. So it might take you a while to understand what you're doing and why. And also I have to mention, bank account analysis statement, the AFP service codes were updated in 2020. I don't think there's been a lot of sessions done on that, so the banks will start using those. So just kind of keep your eyes and ears up for that. And so any sessions on 2020 AFP service codes, those are things you want to look at, just kind of a heads up on that. And so, obviously, we could spend the whole thing on debt, right? Obviously, hopefully we're involved, right, in funding the acquisition and all that part of it. But what you're getting into, right? What's the debt amount? What's the balance sheet? What are the lending institutions? Who are the contacts? Build those relationships, maturities. And I think the thing that's important to me is the agreements, exhibits, and amendments, including all the covenants, right? And the notices required, so you're not in a position where you're missing the covenants. How do they affect your existing covenants, right, with your bank partners? So you want to be communicating with your existing bank partners as well, right? You want to inform your bank partners what you're doing. You're making an acquisition. You might have to amend your existing credit agreement. You might have to amend your covenants. And so let's make sure that we have visibility into what we're getting into as far as covenants, requirements, notices, maturities, right? All the details, and then let's build those relationships on that side of it. And then on the investment side of it, again, this is another webinar. Get a copy of their investment policy. Hopefully they have an investment policy. Again, you want to look at what is that relevant to yours? How do you set the amount of cash you need for daily operations? How do you bring those funds into yours so you're getting the most out of investments? It's really it's even more important in today's environment because of the inflationary environment. Some of the short-term investments are actually going to be worth, putting your money into now. So just leaving money in your bank account is going to be more costly from an opportunity cost perspective. Credit ratings of investments. Again, look at your policies, your corporate policies. Make sure that if there are investments that do not fit into your policy. Maybe you say we're only allowed to invest in BB plus and the acquired company is holding something. How are you going to roll out of those? How do you let the board know what's going on, right? So those are other things you need to look at. And then of course we want to look at relevant for your FASB and your IASB reporting. And so again, all these things are important. And then, all the debt things that there may be liens on those, right? John mentioned sometimes people don't really consider, right, all the things. Maybe there's a lot of capital leases, some leasing. So understanding everything from A to Z is important. On that investment side. And so again, this could be a different thing, but when you look at investments, it's clearly different. Short-term investments you hold, but what about your benefit plans? How are those being managed? How are those being integrated? If you have a hand in that, how do you merge the 401k plans, the blackout periods, all the testing, all the studies? And so those are important. We might touch on those. The FX and the commodity, what's going on in terms of FX and hedging policy. Do they have an ISDA agreement? Are they bringing on exposures you need to manage? If they have contracts, are they forwards, options, etc. Maybe they're using instruments that are not consistent, right, with your policy that's approved by the board. Maybe you're going to need to have your board approve those things because those exposures are needed. Again, you want to see what underlying exposure and measurement methodology they're using. Make sure that, excuse me, that you have visibility there. And then the accounting considerations. And then, as I mentioned, this is probably why I got a corporate treasury benefit plans. Some of our benefit plans were pension plans, and they became material. And so the things you have to deal with by actuaries, and things like that. You want to get the latest trust statements, right? All of the accounts, due diligence. I got nailed by this. I didn't even get all the trust statements. I wasn't involved there. All plan documents, including amendments, all the defined benefit plans, defined contribution plans. I can talk about ESOPs. I can loan policy documents for your folks that have loans, latest asset liability studies, see what kind of liabilities, and then your audit and actuarial reports. And if you're like me, I had to do all the pension plan accounting. So I had to figure out how that was all going to be put together as well. So again, where you stand depends on where you sit. This may not be under your purview in Treasury, but I think it's becoming more common that we are at least the support. I'm sure the CFO is on your benefits committee, so he'll often look to you in Treasury. So any of these areas can be all time consuming, but you have to have your arms around all of it, right? A Treasury acquisition can make or break your career. And so there are so many things that you could miss. Let's just make sure there's always going to be a couple like loose straps around. Let's just make sure that you're not going to get hit with those, especially more than one at the same time. Insurance related items, again, this is something I was close to as well. And this was probably, if I didn't have an insurance broker, this would have been the most difficult piece to understand and get my arms around. What are all the policies for the companies and entities? All the open claims and claims history. What are things we're going to have to address? What's the risk? We're going to get into insurance policy. That's a whole nother webinar. What about the tails on there? How do we integrate them? Do we have captives? Do they have brokers? Do they have surety bonds outstanding? Do they have self-funded workers' comp or any other captives they have? So be aware. All those things can come up for you as well. So let's go ahead. It's been fast and furious with John, a lot of content. Just these things are incredibly important, all the dimensions here. And so again, I'm really express my sincere gratitude to TIS for letting us really dive into this extremely important topic, which doesn't really get enough bandwidth in Treasury events and conferences. So here's my key takeaways before we wrap things up. Prepare, get yourself involved as early as possible, and then just offer to do things. Get visibility into everything. If you don't have visibility, ask people, right? Hey, what's going on in the acquisition? Do you know this? Have you got the documents yet? Can I take a look at those? So people tell you this, you need to be sticking your nose in, right? In terms of an acquisition from the acquired company, don't burn bridges, and their relationships, don't burn bridges with banks, people. So this is incredibly important. Communication is extremely delicate with the acquired company and their personnel and how you communicate. Build those relationships with the acquired company, not only in Treasury. If you go, if you're able to go, build relationships with everyone. Take everybody out to lunch, talk to everyone, see what the culture's like. Tell them how great it is to work at your company. You need to start thinking about consistencies and culture policies. We need to explain those, and then take advantage of opportunities to right size people, process, and technology post acquisition. Let me wrap things up. John, do you have any kind of final thoughts for folks? Just things they want to keep in mind as they're going through this process.
Yeah, I think you made a lot of good points on that last slide. But anybody who's been through one of these before knows it's just a million miles an hour. You're moving so fast, just trying to get to day one, right? So it's just being prepared so that you can continue business as usual once you get to the day one. You're not really thinking about the advantages, the opportunities, how to right size things, maybe that much until after that, right? After that, so the acquisition closes and you move away from that. So definitely realize that despite the amount of work that goes into just getting to day one, there's a lot of work that can be done afterwards as well too, just to take advantage of those opportunities. Definitely think about how to right size, particularly from a technology standpoint. How do you take advantage of technology? Because that's really how you can gain most of the efficiencies as you combine the business. And think about do you have the right technology in place, or was it okay prior to the acquisition, and do you need to improve things too? So definitely kind of take it as a good opportunity to assess those aspects as well.
Okay, thanks, John. Just want to let everyone know I've got our final polling question up. So if you're interested in receiving CTP credit, please, you'll need to answer this polling question as well as the other polling questions that we ask. First, in closing, John, it's always a pleasure to speak with you, and great to have you share your knowledge with us. So thank you so much, John.
Yeah, thank you, Ernie. Great to be here.
Also want to thank TIS as well, a longtime key strategic partner of mine. I also want to let everyone know that both TIS and Treasury webinars, if you're going to be in Chicago at the Windy City Summit, we will both have booths at the Windy City Summit. So please come by if you're there and visit TIS and Treasury webinars. And looking forward to more webinar collaborations with TIS and John as well. So thank you so much, everyone, for your valuable time and your constant support. Make the rest of your day great, everyone.